So, ladies and gentlemen, here we are looking at May 2019. May 2019, question number 3. 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 So, we have already written the cost of equity formula because requirement number 1, they wanted us to give them the cost of ordinary share capital. And the cost of equity is DO into 1 plus G all over PO minus F plus G plus G plus G. So, and I was trying to explain here that what made many students not to get it right, number 1, was how to get the growth rate. And we are saying that our growth rate should always be equal to BR. Not always, but this is the formula that you should have used here, BR, where B is a retention ratio. Out of your salary, how much are you able to retain to go into your investments? Or everything you get goes to the stomach? No. So our G should be equal to the retention ratio multiplied by the return on equity, the return from the investments that we shall be putting these monies retained. So somebody is telling me that this G should be, first of all, the retention ratio they have told us in note number 3. They have told us that the firm adopts a 60% dividend payout ratio. So if the dividend payout ratio is 60%, then, ladies and gentlemen, the retention ratio will be 40%, 0.4. And then they have given us the return on equity. Remember, ROE stands for return on equity. So once I have the 2, I'll be able to multiply, which will end up giving us 8%. The other thing, ladies and gentlemen, that so many students were not able to get is this PO. PO stands for the current market price per share. But remember, these must always be ex-dividend. It must always be without any dividend. It must always be without any dividend. So, ladies and gentlemen, if you read note number 1, they have told us that the current market price of the firm's ordinary shares is quoted at 45. So the current market price of the ordinary shares is quoted at 45. But now they went ahead there and spoiled the broth. They told us 𝒂𝒄𝒉𝒊𝒆𝒗𝒆. So when they say 𝒂𝒂𝒉𝒊𝒆𝒗𝒆, I must look at the current dividend I subtract. When they say 𝒂𝒂𝒉𝒊𝒆𝒗𝒄𝒉, you must look for the current dividend you subtract. Where is the current dividend? If you read note number 2, the firm paid a dividend of 5. So the current dividend is 5. So 45 minus 5, this will give us what figure? This gives us 40. 45 minus 5, this gives us 40. So ladies and gentlemen, the moment I reach here, it will be very easy for me now to finish up the entire requirement in Roman 1. So the cost of ordinary shares is cost of equity, will be equal to the current dividend, which is 5 into 1 plus the growth rate that we got as 0.08 all over the PO, which is ex-dividend, which happens to be 40. Have they given me any flotation cost really? No flotation cost. Just for revision purposes, I can say there minus 0. Minus 0 plus our growth rate again, which is 0.0 what here? 0.08. So could you kindly go ahead and give us this figure for our cost of equity? Here you have to move a little bit slow and ensuring looking at your body mass. So you must come and talk of 5 times 1.08 divided by 40 equals. Whatever you get, you will say plus 0.08 equals. And then at the end of the day, you give us a value in form of percentage. So whatever you get times 100, please give me a figure. Tell me what is the cost of equity. What is the cost of equity? What is the cost of equity? Eunice Mwangi is able to confirm what Chelsea man from Chelsea, this must be a strong supporter of Chelsea, and what Eunice also got. So 21.5, even Judy, 21.5% is correct. In an exam situation, I'm so sure most of us would have really gotten this correct. So I would want us to look at Roman 2. Roman 2, they want us to give them the cost of 12% irredeemable debenture. Irredeemable debenture. So I would want to give you a minute. I don't want to do everything today. Today is your day. It's your wedding. So I can see students who have gotten it correctly, but unfortunately they are the same students who got the other one. I would want everybody to be aboard. I would want everyone to jump in, dive in. So I expect my new students here like Ben and Muzikwa, please participate. Aisha, participate kindly, participate kindly. The ones who are finished, please go on and give us the cost of preference shares. You can see some students have come on board and they have been able to give us the first case there, the second case, they want us to give them the cost of 12% irredeemable debenture capital. So basically they want us to give them the cost of debt, cost of 12% debt. That's an examiner who is wishing me success. That's an examiner who is wishing me success. So cost of 12% debt. So cost of 12% debt, what I will do, ladies and gentlemen, I'll be able to look for the par value of debt. The par value of debt. Par value of debt. Who is able to see the par value of debt? Who is able to see the par value of debt? This is very important for me to be able to do costing, par value of debt, the one given in the balance sheet. The par value of debt is 20. The one given there, 12% redeemable debenture capital into brackets, shillings 20 par value. So the par value here is 20. And once you give me the par value, I will be able to give you the interest. It will be 20 times 12%. Rate of interest has been specified. So times 12%. And if you do that, if I'm not wrong, that should be able to give us, ladies and gentlemen, 2.4. That should be able to give us 2.4. So once I have the 2.4, then getting KD will not be a big thing. KD should be equal to the interest that I have, the interest amount that I have into 1 minus tax, because remember, interest, unlike dividends, is normally tax allowable, all over the market value of the debt instrument. Market value of the debt instrument. Market value of the debt instrument. Again, remember that this market value must be like the ex-div. In this case, we talk of ex-int, ex-interest. It can become interest. So the interest amount that you guys have given me is 2.4 times 0.7. 2.4 times 0.7, 2.4 times 0.7, all over the market value of debt, all over the market value of debt. So please look for market value of debt in the question. The market value of debt in the question is given in note number 5. Note number 5, they have told us the existing 12% irredeemable debentures is currently trading at 112, but now come interest. So it means I have to come and take the 112, but now I less the interest itself, which is 2.4, which is 2.4, which is 2.4. So could you kindly give me this figure? Of course, tax is 30%. So 1 minus 30%, that will be 0.7. So we have here 2.4 times 0.7 divided by 112 minus 2.4. Kindly give me the answer here. Kindly give me the answer here. Whatever you get times 100, whatever you get, change it to percentage. Whatever you get, change it to percentage. Tell me what you are able to get. Who can give me this final answer, ladies and gentlemen, so I can move very fast? The final answer here. KD stands for cost of debt. Cost of debt. Final answer for cost of debt. What are they able to get? Please don't remain silent for too long, because we need to go to other things. Is there somebody who is getting approximately 1.53? Yes. There's somebody who has confirmed there, 1.53%. And then now that takes me to KP. Cost of preference, the same aspect. Preference shareholders, we normally give them what we call preference dividends. So I'll come and take the preference dividend, I divide this by the market value of preference share, market value of preference share. But again, remember, preference dividends, ladies and gentlemen, we don't adjust for any tax. Dividends can never be allowed for taxation. So preference dividend, I would want, ladies and gentlemen, you to give me the par value. We normally start by looking at the par value. The par value of preference from the balance sheet given up there is 25. So if the par value is 25, then I'll easily get the preference dividend by looking at, from that place where we have the par value, we can see it is 14% preference. So 14% is the rate of a preference dividend. So times 14% all over the market value of the preference shares. The market value of the preference shares, they've told us, note number 6, the 14% preference shares are currently trading at 33.5, but it's come dividend. So it has to be 33.5 minus. Please give me what is this figure, ladies and gentlemen, up there? That figure up there, is it 3.5? 3.5. This figure is 3.5. So please, whatever you get, multiply by 100, and I'm able to see somebody giving me 11.67%. So if that is correct, I would want us to go to the last area, which is the WACC. WACC, hiyo ni mswaki. WACC, hiyo ni mswaki. Please help mwalimu to get WACC. Help mwalimu there to give us the WACC. Please help me. So we are looking for W what here? WACC, and I was writing down the book values as given in the statement of financial position. So what we need to do very fast is to come and divide this. We'll come and divide this. We'll come and divide this by the par values. Divide them by the par values. For you to be able to convert into market price, you divide the factors that you have there by the par value, like ordinary shares. Ordinary share capital, the par value here is 20. Debt, the debentures, the par value again is 20. And then we have 14% preference shares, the par value is 25. So once you do that, come and multiply these parameters here with this doesn't have a par value, So come and multiply these parameters by the market price per what year per share. Multiply them with the market price per share. Are you able to see the market price per share? Are you able to see the market price per share? So like, ladies and gentlemen, the market price per share for the ordinary shares. What is the market price per share, somebody? From note number one. From note number one. What is the market price per share for note number one? Market price per share. From note number one. Yes, it has to be ex-dividend. It has to be ex-dividend. So it has to be 40 here. How about the market price per debt instrument, which is trading outside there? The market price per debt instrument selling outside there, please help me. Market price per share, per debt instrument selling outside there, it has to be ex-dividend. So I'm being told it's 109, 109.6, 109.6. And then we have the preference. Preference will be 15,000 divided by 25 times, ladies and gentlemen, what figure do we have there for preference? Is it 30? For preference, thank you very much, Ato, 30. So could you kindly give me these figures? Kindly give me these figures. Kindly give me these figures. Kindly give me the figures. Give me the figures. So like for ordinary share capital, what figure are we looking at? Yes, Eunice. Please give me the total here, ordinary share capital, Subo. Ben. What figures are we looking at? Somebody talk to us. Ordinary share capital, the market price. I'm being told ordinary is 100 million. 100 million. Let's put our figures in thousands or in millions. So 100. Retained earnings, of course, as you guys are aware, there is no any adjustment. No adjustments at all. No adjustments at all. How about debt? Debt, what do we have here under debt? 137,000. So 137. Thank you and thank you very much. How about preference? Debt unit is confirming again. 137K. I've decided to work without the decimals, or rather without the zeros. Yes, preference 18. Thank you and thank you very much. So I would want proportions. Remember, there is this school of thought which tells us whenever we are getting WACC, we exclude retained earnings. There's this school of thought which tells us that to get WACC, talk of weighted, or rather weight of equity, cost of equity, plus weight of preference, cost of preference, plus weight of debt, cost of debt. And to them, equity should be the ordinary shares that we are going to raise. That still is okay. You get some people telling, and they're correct. If you look at CASDEB solutions, whenever we mark, there are those students who will argue, remove 30, others will say, put 30 there. This time around, let's put that 30 there. Let's put it there. So could you kindly give me the total? Kindly give me the total here. What is the total capital structure amount? The total is 255. Thank you and thank you very much. So having gotten 255, could you kindly give me the weights here? How do you get the weights? Remember, to get the weights, you must always make use of what here? The market values. You must always make use of the market values. Always make use of the market values. So take 100 divided by this, 2 decimal places, give me figures. 2 decimal places, give me figures. Two decimal places, give me figures. Okay, so the weight, I'm being given a figure here. I'm being given a figure by Eunice, 0.39, 0.39. So 0.39. How about retained earnings? What is 30? 30 divided by 255. There is somebody giving me one for debt of 0.54. Debt 0.54. Debt 0.54. Debt 0.54. So I'm now waiting you guys to give me a figure for retained earnings and a figure for preference. A figure for retained earnings and a figure for preference. So preference, I'm being given 0.07. Preference, I'm being given 0.07. How about retained earnings? Retained earnings. So retained earnings, I'm being given 0.12. And if you add, of course, all the proportions, you'll end up getting 1 or thereabout. 1 or thereabout. It has to be something close to 1. So from there, come and give me the costs. The cost. So the cost, what do we have cost? Remember, cost of equity ordinary shares, you already have the figure. Cost of equity ordinary shares, you have a figure. I have the figures myself. I could simply come to them. And then I make reference very fast. Problem is that they are not talking to me so much. Yes. So the cost of ordinary shares, we got a figure of 21.5%. 21.5%. Retained earnings, of course, falls under equity. It will also be 21.5%. But now remember, ladies and gentlemen, that these two have only been able to have the same figures because we don't have flotation. If flotation cost was there, then automatically the cost of equity ordinary shares would have been different from cost of equity retained earnings, because under equity ordinary shares would have taken into consideration the flotation. Would have taken into consideration the flotation. Would have considered the flotation. Is that okay? Now from ladies and gentlemen, we move on to the next one. The next one is cost of what here? The cost of the debt. So cost of the debt is what you guys got. 1 point something. What is the cost of debt? Cost of debt. Please give me the cost of debt. The cost of debt. The preference I know is 11.67. Preference I know it's 11.67. So that must be the one that you guys got. 1.53. So please come and give me the weighted cost. Come and give me the weighted cost at the end of the day here. Come and give me the weighted cost. So the weighted cost, basically we are taking this times this. 2 decimal places. Weighted cost, 2 decimal places. Tell me what we have. Weighted cost, 2 decimal places. Tell me what we have. I don't have a calculator. Can somebody give me these figures very fast? And if possible, come and add for us all of them for you to give us the WACC. Give us the WACC. You add for us. Give us the WACC. Talk to us. Give me the WACC at the end of the day. What figure shall we get there? So the total, the WACC, I'm being given by somebody here. We are looking at something like 12 point what here? 61. 12.61. 12.61. WACC, I'm being told here, it should be about 12.61%. Because if you remember, our WACC, like how we normally get weight of equity, cost of equity plus. So even if you, I'm so sure most of you omitted the retained what here? Retained earnings. Most of you omitted retained earnings, but the better approach, of course you are right. I told you there are 2 answers to this. You are right, but the better approach is to include everything. You include everything like that. Now, ladies and gentlemen, straight away let us knock out the November 2018. November 2018, question number 1B. November 2018, question number 1B. That is yours. November 2018, question number 1B. So we are doing November 2018, question number 4 boy. November 2018, question number 4 boy. So this is quite an easy question, very easy question. It's November 2018, question number 4B. November 2018, question number 4B. So they're telling us there that New Ways Limited intends to raise new capital to expand its production level. The 𝒂𝒏𝒂𝒓 has already gotten it. The company plans to undertake the following financial decisions. Issue 200,000 ordinary shares, which have a par value of shilling 16 per share. The flotation cost per share is shillings 1. So issue 75,000 12% preference shares, which have a par value of 20 at shillings 18 per share. Shillings 18 per share. The total flotation cost is 150,000. 3. Issue 50,000 18% debentures, whose par value is 100 at 80 per debenture. Borrow 5 million 18% long-term loan. The total flotation cost is shillings 200,000. Note number 1, they want us to give them the total capital to be raised net of any flotation cost. So total capital to be raised. Total capital to be raised. So the total capital that you're going to get here, the first amount is the one that will come from ordinary share capital. Ordinary share capital, ladies and gentlemen, ordinary share capital, they have told us it is 200 ordinary shares, not one, which have a par value there. And then they have given us the flotation cost per share is shillings what here? Is shillings 1. So then the total amount we shall get here will be 200,000 times what? 16. Because of course they haven't given us the market value of a share. We'll take this to be the same as the market price per share. But remember, out of this total that we shall be raising, ladies and gentlemen, we also have to part something to the promoters, what we call the flotation cost. And the flotation cost, they have told us we shall be incurring a flotation cost of 1 per share. Shillings 1 per share. So remember, they want us to give them the total capital to be raised less any flotation cost. So what will be coming to the company? What will be coming to the company? So could you kindly give me this answer, ladies and gentlemen? What do we have here? Please move with speed because I'm told there is a class I'm supposed to be stepping in for someone who teaches Excel. It's quite late. I'm supposed to be holding brief for him. Alternatively, I could just leave you so that you can finish the entire question, and then some students are proposing that we introduce another class for this, which we shall be discussing with your management, which day it should be, either on Monday or Wednesday. So I'll be able to communicate. So please finish that question, and if possible, you do the one of May 2018, question 3A. May 2018, question 3A. So I'm being given a figure of 3 million, but time is not on our side. So we have here 3 million. Go to the next vehicle. The next vehicle here is called preference shares. So for preference shares, what do we have? For preference share, a couple have told us, issue 75,000. And I can see the market price is 18. Minus the total flotation cost of preference shares, which is 150,000. So could you kindly give me the final answer in shillings thousands? In shillings thousands, tell us what do we have there? Please move with speed, move with speed. That's preference shares. And then we have debentures. Remember here, they have given me the market price. They've given me the market price. So according to 𝒂𝒏𝒂𝒓, this is supposed to be 1,200. This is supposed to be 1.2 million yes in terms of thousands. My figures are in terms of thousands. My figures are in terms of thousands like that. So debentures, we have 50,000, but we're selling them for 8 above. We are selling them for 8 above. We are selling them for 8 above, right? And unfortunately, there is nothing like flotation. So there is no flotation at all. So could you kindly give me the debentures figure? The debentures. Please here, many students who are using the par values. Don't use par values. When you're looking at how much do we raise, you're going to sell things outside there, and as such, we should be able to use the market prices. We should be able to use the market prices. So debentures, what figures do we have? 4,000 from Atho. And then we have the long-term loan. The long-term loan. So the long-term loan, what do we have? It's 5 million, but here we have got it's 5 million, but now here we have got 200,000 as flotation. We've got 200,000 there as flotation, 200,000 as flotation, 200,000 as flotation. So I'm being given 4 million. No, that is for debentures. How about long-term loan? Long-term loan, I'm being told, is 4,800. So please come and add. And according to Bwana Atho, we should be able to get 13,000 in terms of shillings what year? Thousands. And then number two, they would want us to give them, ladies and gentlemen, the WACC. Remember WACC, I'll come and repeat everything. Although when you are getting the weights, you don't subtract flotation cost. Remember, when you're getting the weights, you only use the market values. Market values. So when you're getting the weights, we'll use everything apart from now. This subtraction here will not be there. The subtraction will not be there. And then now we have all the other parameters. Thank you, and thank you very much. We have to cut it at this particular point. So I'm so sure you must have gotten something, however small. You're not going back the way you came. So asanteni sana. Abby says it's WMCC, not WACC. Fine. We'll be looking at the difference between the two. There is even somebody who asked that kind of a question up there. Let's look at the difference between the two in our next class. Thank you. No, I can't finish. I can't finish because there is something that I'm rushing to. I'm sorry. Please.